US retail sales for June beat expectations in another sign that the economy is coping with high interest rates. Welcome to Market Insight, I'm Thomas Warner. June's retail sales were unchanged from May. Analysts had been expecting the steepest drop since January. And core retail sales, which feed directly into GDP data, actually jumped 0.9%. The surprise show of strength could make a September cut to interest rates less likely, and it may also suggest that the US consumer is bearing up better than had been feared. With me to share her thoughts on Tuesday's figures and the wider state of US retail is Sharon Martis, Director of Consumer Research at the London Stock Exchange Group. A very warm welcome to you there. That core retail sales number was very striking, Sharon. What do you think it means for the consumer?
It's good to be here, Thomas. So although June retail sales came in stronger than expectations, LSEG is still forecasting a single-digit earnings growth rate for the second quarter. And this is a slowdown from what we've seen over the last 2 years, mainly because the consumer has shifted in their spending behavior. This is because of the macroeconomic conditions. They're still dealing with stickier inflation, higher prices that are making them be more value oriented. And that was very evident in the last few earnings calls that we've had from retailers, where they all are in agreement that the consumer is becoming savvier and looking for those discounts and promotions. They are waiting for those deals in order to open up their wallets.
Really has been the story of the last couple of years, hasn't it? But in the event that things do start to get a little bit easier for people, how much of that changed behaviour do you think would be maintained into a new, slightly easier era, Sharon?
So the one economic indicator that our consumer confidence data tells us that consumers are watching very closely is the employment data. So if consumers feel secure about their career and their job security, then they're going to continue to spend freely. However, if the inflation continues to be sticky and they start seeing their friends and family lose their jobs, the unemployment rate starts to go up. That's when we can see a significant pullback on spending. So that's the one economic indicator that we're watching very closely.
I'm sure you're also watching Prime Week very closely. Obviously, we know that a lot of retailers are on that Amazon bandwagon, offering discounts of their own. How is this year's Prime Week likely to compare with recent ones, and who do you think are going to be the big winners and losers?
Absolutely. So Amazon is likely to see a 5% growth according to our LSEG data in terms of revenue for the quarter that Prime Week falls in, which means that in terms of revenue, they will still be seeing the strongest numbers. Now, a lot of that comparison shopping, as we mentioned, consumers are all about value and they're looking for the lower prices, is going to be happening online. And having said that, the one retailer that is expected to see the biggest year-over-year growth is Walmart at 15%, followed by Amazon's 4% and Target's 3%. Still, it's all about membership, who can bring in the most members during the season. And the one discounter that analysts polled by LSEG are the most bullish on is Walmart. They still believe that when we look at our projections, that Walmart is likely to see membership grow to 9% by the end of the year. Still, Amazon will still succeed and still see strong numbers from Amazon Prime. In fact, our StarMine Smart Estimates data suggests that the discounter is likely to beat earnings estimates and post a positive surprise for the quarter.
And Sharon, we know that Walmart have taken the quite bold step of shaving 50% off their subscription scheme this week. Do you think that's a wise strategy from them?
Absolutely, because the consumer is very value oriented. And so when we look at where they are right now, even for the quarter that includes Prime, they're expected to see a 7.4% growth in their membership because of these events, the discounting events. And when we look at the forecast for the remainder of the year, it's expected to grow to almost 10% by the end of the year. So Walmart has been very successful already and still bringing in those high-end, upper middle class consumers that are trading down significantly. And when we look at the forecast, we expect that to continue for the rest of the year. Also because of their strong omni-channel presence, and they continue to add a lot of products on their website.
Well, you've mentioned Walmart there. They were one of the standout performers from the last earnings season, and we are about to embark on another one. Who have you got your eye on?
When in terms of sectors, value and discounting is what's on consumers' minds. So those are going to be the biggest winner, the discounters, the off-price retailers. Now, in terms of individual names, it's interesting because no matter how the economy is doing, back to school happens every year and parents are budgeted for it. So we're seeing that Walmart will be the one-stop shop for the back to school deals. Target also ramping up their back to school deals right now for what they call Cycle Week. And also, when we look at individual names, Abercrombie and Fitch is one to watch as teenagers gravitate towards that retailer. It's become a favorite one. But still, our StarMine data suggests that Gap is likely to beat earnings estimates and post a positive surprise. And this is mainly because of its Old Navy division has become very popular. And also, we're seeing a lot of sporting events this year. Also, the Olympics is coming up. So more and more, we're finding that even going into Prime Week, that consumers are searching for a lot of um, athletic wear, and so therefore Athleta, which is owned by Gap, is also going to be receiving a boost.
Sharon Martis, Director of Consumer Research at LSEG, thank you very much indeed for your time. And that is your Market Insight. You can watch more videos on Reuters.com.